Welcome back to Market on Close. I'm Diane King Hall. Let's take a look at the commodities market with Phil Strebel, Chief Market Strategist, Blue Line Futures. Phil, it is good to be with you this Friday. All right, we've got to start out with oil. Obviously, crude has been in focus ever since the geopolitical tensions began between Israel and Iran. We saw the spike in oil prices. WTI would have settled around just under $75 a barrel today. So what are the key technical levels that you're watching when it comes to crude?
So still, it's going to be kind of the range of the high and the low this week. Really, it's like the $70 on the downside up to 79 on the upside. The factors that really traders need to weigh in is like what the dynamics of this conflict are going to be. They give it about a 50% probability that this is going to be a longer, drawn out process. And with that type of environment, you're going to see higher crude oil prices for longer. Call it the $75 to $80 band range. If you do see all of a sudden compliance with Iran, they start to dismantle, really these geopolitical tensions die down, will still remain somewhat elevated, but it's going to be closer to that $60 to $65 range. And then they give that about a 20% probability. And then you've got a 30% probability that, these things really linger on and they get more aggressive in the short run. That's where you'd have a closing of the Straits of Hormuz, some kind of direct attack on U.S. assets and things like that. That's where you're going to get even that more dramatically higher price. You get the $85 up to $100 price range.
I don't know that anyone besides a trader wants to see that. As a consumer, I'm like, I don't want to see that because then my pump prices go up. But it feels like it's a coin toss when you're looking at oil because, we don't know what's going to happen. We hear that there's obviously some attempts at negotiations and a movement towards diplomacy between Israel and Iran, thanks to some leaders from Europe. And then President Trump seems to be trying to buy some time on the negotiation front before we see anything in terms of the U.S. stepping in. It feels like regardless of what happens, this might be a little bit more drawn out than expected. So what do you say when it comes to, traders trying to chase momentum here?
So the problem with the markets, and this was really today and over the last 3-4 days, is that the headlines are really driving market flows where 1 minute things look great. We've got some kind of deal. We're working out some framework with Iran. And that was where the market was rallying this morning. We had that gap higher and we were moving up. And then shortly after Iran rejects certain parts of an agreement, prices start to fall. You got sirens going off. I mean, it's just kind of chaos as far as the headlines are concerned. I could tell you that a risk-off sentiment most likely going into the weekend because anything could possibly happen. And you want real financial advice, fill your car up before you on your way home from work today.
Okay, so that's it. That's the takeaway for me. Fill it up now before those prices go higher. Well, what criteria do you use to decide when a move in crude and WTI in particular is tradable?
Okay, so you got to define your time frame, whether it's intraday, swing trade, or longer term. And I can tell you that we've broken out to the upside on the long term. So you just got to define your levels, and what you'll do is back it up to a daily chart. Look at where the last 2-3 day swing low is. You want to put your stop below that kind of low if you're going to play to the upside. I would say if you get that breakout up over the recent high, which has been about $77, you're probably going to see increasing geopolitical risks and prices should continue to move and catch that momentum higher. So you really want to define your levels here, define your risks, use the average true range, and use those key levels for breakouts for adding and reducing positions.
All right, let's talk a little bit about the price action in gold. It's been little change today. It's essentially on track for a weekly loss, but gold for this year, it's been an outperformer. What levels are you paying attention to when it comes to gold?
So 34.10, you need to see a breakout above there in order to recapture that bullish momentum. 33.50 on the downside, which was just about tested earlier. That's going to be your first phase level of support. If we break that, we're probably going back down to the consolidation range between 32.95 and 33.30. The problem that gold had this week, and it's one of the first weekly losses in a month, is that when the Fed came out with that policy statement, everything looked great. But then they took out one interest rate cut on the back end. And what's that do? It raises the terminal rate, and the destination has been slightly changed. So a lot of these markets had to reprice as a result of that, gold being one of them.
Okay, so gold having to reprice as a result of that. Do you expect gold to reclaim some of its momentum? I mean, that's been the safety trade this year. Bonds haven't even performed to the same degree that we've seen gold perform as a hedge. And even when we see risk on, sometimes we see, a move into gold. What's your expectation, especially when you think about the second half of this year? Phil?
A huge dynamic change and a shift in central banks in the way that they operate. You go back to like 2000 and it was 71% of their holdings was in US dollars and then other currencies, and gold would be a small sliver of it. Now US dollar holdings have trickled down to about 51%, and where they've reallocated that was repatriating back to their own currencies or holding gold. So as long as that central bank demand continues to have good flows, you're going to see the floor on gold continuously rise. One other thing, ETF flows, I believe they've gone up like 5 or 6 straight days, the longest winning streak since April. So people really believe in the gold trade. And if you look gold, I think realistically, you're on target, $3,700. Go a year out, 4,000 seems likely.
Okay, 4,000 seems likely a year out. All right, that's something we'll pay attention to. Let's talk a little bit about yields. Looking at the 10-year, it's off by just a basis point. What are you paying attention to when it comes to yields, and especially on the 10-year?
10-year yields have been drifting lower for past like week and a half or so. The whole problem is that foreign banks don't want to hold U.S. treasuries at all. They're concerned about our fiscal policies, our political policies, and everything else. So they have been going into gold. So unless you can get some kind of sense of reassurance that we're heading in the right direction, this is almost like our own Brexit that's going on here. If we can get out of this, get some clarity on things going forward, and Fed policy and fiscal policy and political policies, then we'll start to see the inflows come back in and yields will head lower.
Okay, Phil, quick thought on levels you're paying attention to when it comes to the dollar. The dollar index.
The dollar, you got to get over 93.50. You'll probably travel back up to 100. Series of lower highs, and they're bear market all year long, down 8-9%. Small bounce this week, about 0.5%, but they've been just selling every rally that's in there. So this is probably just another bear market bounce that we experienced this week, and it'll continue to go lower.
Okay, but potentially bear market bounce that we're watching in the dollar. All right, that's Phil Strebel, Chief Market Strategist, Blue Line Futures, with a look across the commodity space. Thank you, Phil. Coming up, we're going to close.